Hello, and welcome to the first step of your investing journey. If you're listening to this, chances are you've decided to take control of your financial future, and that is a truly significant decision. For many, the world of investing can seem like an exclusive club with a complex language filled with jargon like bulls, bears, and basis points. It can feel overwhelming, but the goal of this series is to act as your guide, to break down these barriers, and to show you that investing is more accessible today than ever before. Over the next several chapters, we will be comparing some of the most popular investment apps in the United States, helping you understand their features, benefits, and potential drawbacks. We'll equip you with the knowledge to confidently choose the right platform to match your personal financial goals. Now, before we dive in, it is absolutely essential that we start with a very important disclaimer. The content provided in this entire series is for informational and educational purposes only. We are not financial advisors, and this is not financial, legal, or tax advice. All investments involve risk, and it is possible to lose money. The information presented here is not an offer or solicitation to buy or sell any securities. You should always conduct your own thorough research and consider consulting with a qualified and licensed financial professional before making any investment decisions. Your financial situation is unique, and any action you take based on the information from this series is solely at your own risk. So let's start with the most fundamental question. What exactly is investing? In the simplest terms, investing is the process of using your money with the intention of making more money. Instead of letting your hard-earned cash sit idle, you put it to work in various assets with the expectation that they will grow in value over time. This is fundamentally different from saving. When you save, you typically put money into a very safe place, like a bank savings account. It's there when you need it, which is great for emergencies or short-term goals. However, the interest you earn in a savings account is usually very low. This brings us to a silent threat to your wealth: inflation. Inflation is the rate at which the general cost of goods and services rises, and as a result, the purchasing power of your money falls. If your savings are earning 1% interest, but inflation is at 3%, you are actually losing 2% of your purchasing power every year. Your money is becoming less valuable over time. This is where investing comes in. The primary goal of investing is to generate a return that outpaces inflation, allowing your wealth to grow. This growth is driven by a powerful concept you may have heard of: compound interest or compounding returns. Albert Einstein is often credited with calling it the eighth wonder of the world. Compounding is the process where the earnings from your investments start to generate their own earnings. Imagine you invest $100 and it earns a 10% return in the first year. You now have $110. In the second year, you're not just earning a return on your original $100, but on the full $110. This creates a snowball effect that, over long periods, can turn even modest initial investments into substantial sums. It's the single most powerful tool for building long-term wealth, and the earlier you start, the more time you give your money to grow. Not too long ago, getting started with investing was a cumbersome and expensive process. You often needed to have a significant amount of money, sometimes thousands of dollars, just to open an account with a traditional brokerage firm. You would then have to call a stockbroker to place a trade, and each trade came with a hefty commission fee. This system created high barriers to entry that kept many everyday people on the sidelines. The digital revolution completely changed this landscape. The rise of financial technology, or fintech, has democratized investing. Today, with a smartphone and an internet connection, you can start investing with as little as $1. Investment apps have broken down those old barriers. They offer features that were once unimaginable for the average person. One of the biggest game changers is the introduction of commission-free trading for stocks and other assets. This means the cost of buying and selling is no longer a major hurdle. Another revolutionary feature is the ability to buy fractional shares. In the past, if you wanted to invest in a company with a high stock price, like several hundred or even thousands of dollars per share, you had to buy at least one full share. Fractional shares allow you to invest by the dollar amount. You can buy $10 worth of any company, giving you a small piece of ownership, and allowing you to build a diversified portfolio, even with a small amount of capital. These apps are designed with a user-friendly interface, making the process of investing intuitive and far less intimidating for a beginner. Before you download your first app and make your first investment, it's crucial to understand a few core principles. These concepts will form the foundation of your investment strategy, regardless of which platform you choose. First is risk tolerance. This is perhaps the most personal aspect of investing. It refers to your ability and willingness to handle potential losses in your portfolio's value in exchange for the possibility of higher returns. Are you someone who would panic and sell everything if the market dropped by 20%? Or are you comfortable with short-term volatility for the chance at long-term growth? Understanding your risk tolerance, or your sleep-at-night factor, is critical because it will guide the types of investments you choose. Second, let's briefly touch on asset classes. This is simply a way of categorizing different types of investments. The most common ones for beginners are stocks, bonds, and ETFs. Think of a stock as buying a small slice of ownership in a company. If the company does well, the value of your slice can go up. A bond is like a loan you give to a company or a government, and in return, they promise to pay you back with interest. They are generally considered less risky than stocks. Finally, an ETF, or exchange-traded fund, is a basket that holds many different investments at once, like hundreds of stocks. This provides instant diversification. And that brings us to our third concept, diversification. You've probably heard the saying, don't put all your eggs in one basket. This is the essence of diversification. By spreading your money across different asset classes, industries, and geographical regions, you reduce your overall risk. If one part of your portfolio is performing poorly, another part may be doing well, helping to balance things out. It is a fundamental strategy for managing risk over the long term. Hello and welcome back. In our first chapter, we laid the groundwork for our investing journey by discussing the fundamental concepts every beginner should know. Today, we begin our exploration of the specific tools you can use by taking a deep dive into one of the most talked about and influential investment apps in recent history, Robinhood. Whether you're a seasoned investor or completely new to the scene, it's almost impossible not to have heard of Robinhood. It launched with a disruptive mission to democratize finance for all. Its introduction of commission-free trading sent shockwaves through the entire brokerage industry, forcing many established players to follow suit. In this chapter, we will provide a balanced and objective look at the Robinhood platform. We'll explore its key features, weigh its pros and cons, and discuss the controversies that have followed it. Our goal is to give you a clear picture of what Robinhood offers so you can determine if it aligns with your personal investment style and goals. And once again, we must begin with our important disclaimer. The information in this chapter is for educational and informational purposes only and does not constitute financial, legal, or tax advice. We are not endorsing or recommending any specific investment platform. All investing involves risk, including the potential loss of your principal investment. Please conduct your own extensive research and consider speaking with a qualified financial professional before making any decisions. At its core, Robinhood is a mobile-first brokerage platform designed to make investing simple, accessible, and affordable. Its standout feature, especially when it launched, was offering commission-free trades on stocks, exchange-traded funds, ETFs, and options. This immediately set it apart from traditional brokerages that charged a fee for every transaction. The user interface is a major part of its appeal. The app is known for its clean, minimalist, and intuitive design. The process of signing up, linking a bank account, and placing your first trade is streamlined to be as frictionless as possible. This focus on user experience was specifically intended to appeal to a new, younger generation of investors who were comfortable managing their lives through a smartphone. As we discussed in our last chapter, Robinhood also popularized fractional shares, allowing users to invest in high-priced stocks with just a few dollars, which was a massive step in breaking down barriers for those with limited capital. Beyond stocks and ETFs, the platform has also expanded to include cryptocurrency trading and options trading, offering a wider range of assets for its users. There are several clear reasons why Robinhood has attracted millions of users, particularly beginners. First and foremost is the cost. The commission-free trading model is a powerful draw. For a new investor starting with a small amount of money, trading fees can significantly eat into potential returns. Removing this cost makes it much more feasible to invest small amounts regularly. Second is the user-friendly interface. The app successfully strips away much of the complexity associated with traditional investing platforms. The design is visually appealing and easy to navigate, which can make the process of investing feel less intimidating and more manageable for someone just starting out. Third is the low barrier to entry. With no account minimums, you can literally start with $1. This, combined with fractional shares, means you can start building a diversified portfolio of well-known companies without needing thousands of dollars. Finally, the platform offers instant access to funds. When you deposit money from your bank, Robinhood often gives you instant access to a portion of it for trading, so you don't have to wait several business days for the funds to clear. This allows users to act quickly on investment ideas. Despite its popularity, Robinhood is not without its significant drawbacks and has faced a great deal of controversy. A primary criticism is the concept of gamification. Critics argue that the app's design, with its simple interface and celebratory animations, can make investing feel more like a game than a serious financial endeavor. This can potentially encourage frequent, impulsive trading rather than promoting a long-term, strategic approach, which is generally more successful for building wealth. Another major point of contention is Robinhood's primary revenue source: payment for order flow, or PFOF. This is a complex topic, but here's a simple breakdown. When you place a trade on Robinhood, they don't send it directly to a major stock exchange like the NYSE. Instead, they route your order to large trading firms known as market makers. These firms pay Robinhood for the right to execute your trades. Critics argue this creates a potential conflict of interest. The system incentivizes Robinhood to route orders to the firm that pays them the most, not necessarily the one that can get you the absolute best price on your trade, a difference that can add up over time. This practice is central to their business model and has drawn scrutiny from regulators. Furthermore, Robinhood's educational and research tools are quite limited compared to more established brokerages. While they have a collection of articles called Robinhood Learn, the platform lacks the deep analytical tools, stock screeners, and in-depth research reports that can help investors make more informed decisions. This means users often have to rely on outside sources for their research. Finally, the platform has experienced significant outages during periods of high market volatility, which has left users unable to access their accounts and manage their investments at critical times. When it comes to the safety of your money, it's important to know that Robinhood is a regulated entity. It is a member of the Securities Investor Protection Corporation, or SIPC. SIPC protects the securities and cash in your account up to $500,000, including a $250,000 limit for cash, in the unlikely event that the brokerage firm fails. This is standard protection across the industry. It's crucial to understand, however, that SIPC does not protect you from investment losses due to market fluctuations. If you buy a stock and its value goes down, that is a risk you assume. Robinhood is also regulated by the Securities and Exchange Commission, SEC, just like all other U.S. brokerages. So who is Robinhood a good fit for? Robinhood may be suitable for a cost-conscious, confident beginner who primarily wants to buy and hold stocks and ETFs in a simple, mobile-friendly environment. Its intuitive design is excellent for getting your feet wet and learning the basic mechanics of placing a trade. However, it may not be the best choice for investors who want to perform in-depth research, require robust customer support, or are concerned about the potential conflicts of interest associated with payment for order flow. It is also less suitable for those who might be tempted by the app's design to trade too frequently or speculate on risky assets without a solid strategy. Ultimately, Robinhood played a pivotal role in making investing accessible to the masses. But its simplicity comes with trade-offs. In our next chapter, we will explore a different kind of platform, a traditional, full-service brokerage that has adapted to the new, low-cost world of investing while offering a much wider array of tools and resources. Thank you for joining us. Hello and welcome to Chapter 3. In our last discussion, we explored Robinhood, a platform that revolutionized the investing world with its simplicity and commission-free model. Today, we're shifting our focus to a different kind of player, an established industry giant that has successfully adapted to the new landscape of investing. We are talking about Fidelity. Founded decades before the internet was a household name, Fidelity has built a reputation as a trusted full-service brokerage. But don't let its age fool you. Fidelity has embraced modern features, making it a formidable contender for new and experienced investors alike. In this chapter, we will unpack what Fidelity offers the modern beginner. We'll look at how it blends a massive selection of investment options and powerful research tools with beginner-friendly features, and a surprisingly low-cost structure. Our goal is to provide a clear, balanced overview so you can understand if this powerhouse platform is the right place for you to grow as an investor. And as always, we must start with our crucial reminder. This content is for informational and educational purposes only. It is not financial, legal, or tax advice, and should not be treated as a recommendation to use any specific platform or make any particular investment. Investing involves inherent risks, including the potential loss of your money. It is essential to conduct your own independent research, and consider consulting with a licensed financial professional to discuss your individual circumstances. Unlike the mobile-first startups we've discussed, Fidelity is a comprehensive financial services company. It offers everything from retirement accounts and managed portfolios to credit cards and financial planning services. For the purpose of our discussion, we'll focus on its brokerage platform, which allows you to buy and sell investments. While Robinhood's appeal is its streamlined simplicity, Fidelity's strength is its sheer depth and breadth. It's designed to be a platform that an investor can start with and never outgrow. As your knowledge and assets grow, Fidelity has the advanced tools, account types, and investment products to support your evolving needs. Like its modern competitors, Fidelity offers zero-commission online trading for U.S. stocks and ETFs. It also provides access to fractional shares, which they call stocks by the slice, allowing you to invest with as little as $1. This combination of legacy trust and modern features makes it a unique hybrid in the brokerage world. Fidelity presents a very compelling case for new investors, and here are some of the biggest reasons why. First is the incredible range of investment options. Beyond stocks and ETFs, Fidelity provides access to thousands of mutual funds, including their own proprietary line of Fidelity Zero funds. These are index mutual funds that have a 0% expense ratio. That means there are no management fees or internal costs, allowing you to keep literally all of your returns. This is an incredibly powerful and cost-effective way for a beginner to build a diversified portfolio. Second, and perhaps most importantly, are the outstanding research and educational resources. This is where Fidelity truly shines and sets itself apart from simpler apps. The platform provides a wealth of information, from in-depth stock analysis and third-party expert reports to market news and economic calendars. Their learning center is packed with articles, videos, and webinars covering everything from basic investing principles to advanced trading strategies. For a beginner who is eager to learn and grow, these resources are invaluable. Third is excellent customer service. Investing can be confusing, and having reliable support is crucial. Fidelity offers 24/7 customer service through phone, live chat, and even at physical investor centers located across the country. This level of support provides a significant sense of security for a new investor navigating their account for the first time. Finally, for those who want a more hands-off approach, Fidelity offers Fidelity Go, their robo-advisor service. You simply answer a few questions about your goals and risk tolerance, and Fidelity Go will build and automatically manage a diversified portfolio for you. There are no advisory fees for balances under $25,000, making it an excellent, low-cost option for beginners who want professional management. While Fidelity is a top-tier platform, it's not without its potential downsides for a complete novice. The primary challenge can be the overwhelming nature of the platform. Because it is so comprehensive and feature-rich, the website and even the mobile app can feel more complex and less intuitive than a stripped-down app like Robinhood. A new user might experience a steeper learning curve trying to navigate the vast amount of information and tools available. It can take some time to learn where everything is and how to use the platform effectively. Another drawback for some is the lack of a dedicated paper trading feature. Paper trading allows you to practice investing with virtual money, which is a fantastic way for beginners to learn the mechanics of trading without any real-world risk. While some competitors offer this, Fidelity currently does not, meaning your first trades will be with real capital. Finally, while the mobile app is very capable and has improved significantly over the years, some users may find it less sleek or gamified than newer fintech apps. It's built for function over form, which some may see as a positive, but others might find it less engaging. Fidelity's pricing is remarkably competitive. As mentioned, they offer $0 commissions for online trades of U.S. stocks, ETFs, and options. It's important to note that for options, while the base commission is $0, there is still a standard per contract fee of 65 cents, which is an industry standard charge. There are no fees for account maintenance, inactivity, or bank transfers. The Fidelity Zero funds truly have a 0% expense ratio. If you choose to invest in other mutual funds, it's important to check their specific fees, as some can carry transaction costs or higher expense ratios. But for the core needs of a beginner building a portfolio of stocks and ETFs, the platform is virtually free to use. So who is the ideal user for Fidelity? Fidelity is an outstanding choice for the beginner investor who is serious about learning and wants a platform they can grow with for the long term. If you are someone who wants to do your own research, values access to a wide variety of low-cost investment options like the Zero funds, and wants the security of robust customer support, Fidelity is arguably one of the best platforms available. It is particularly well suited for those focused on long-term goals like retirement planning. However, if you are looking for the absolute simplest, most minimalist entry point into trading, and feel you would be easily overwhelmed by too many options and data, you might find the platform a bit daunting at first. It requires a bit more initiative to learn than some of its simpler competitors. Fidelity successfully bridges the gap between a traditional, trusted brokerage and a modern, low-cost platform. In our next chapter, we will look at another industry giant and a name synonymous with long-term, low-cost index investing, Vanguard. Thank you for joining us. Hello and welcome back to our series. In our last two chapters, we explored the sleek, mobile-first design of Robinhood and the feature-rich, all-in-one ecosystem of Fidelity. Today, we turn our attention to a company whose name is synonymous with a specific, powerful investment philosophy, Vanguard. Founded in 1975 by the legendary John C. Bogle, Vanguard is more than just a brokerage. It's the pioneer of low-cost index fund investing for the individual investor. The entire company is built around a single, guiding principle: that by keeping costs as low as possible and tracking the market as a whole, long-term investors can achieve greater success. In this chapter, we'll explore the unique structure of Vanguard, its unwavering investment philosophy, and what its platform offers to a beginner. We'll examine why, for a certain type of investor, Vanguard isn't just a good choice, it's the only choice. And as we always do, we must begin with our fundamental disclaimer. This presentation is for educational and informational purposes only and should not be considered financial, legal, or tax advice. We are not recommending or endorsing any specific investment platform or strategy. All investments carry risk, and it is possible to lose money. Please be sure to conduct your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. Section 1. The Vanguard philosophy and its unique structure. To understand Vanguard, you have to understand its core philosophy. John Bogle's revolutionary idea was that trying to beat the market by picking individual stocks or timing your trades is, for most people, a losing game. Instead, he advocated for buying the market itself. This is achieved through index funds and ETFs, which are designed to simply match the performance of a market index, like the S&P 500. By doing this, you capture the overall growth of the market over the long term. A key part of this philosophy is a relentless focus on cost. Bogle argued that investment fees are the single most significant drag on your returns. Even a small difference in fees can compound into tens or even hundreds of thousands of dollars over an investing lifetime. What makes Vanguard truly unique is its corporate structure. Vanguard is not a publicly traded company owned by outside stockholders. Instead, the company is owned by its own funds. Those funds, in turn, are owned by the people who invest in them. That's you, the investor. This client-owned structure means there is no conflict of interest between outside owners demanding profits and investors wanting low costs. Vanguard's profits are returned to the investors in the form of lower fees, or what they call expense ratios. This structure is the engine that drives their ability to consistently offer some of the lowest cost investment products in the entire industry. Section 2. The pros: why investors choose Vanguard. The advantages of using Vanguard are directly tied to its core principles. The most significant pro is the extremely low cost. Vanguard's average expense ratio on its ETFs and mutual funds is dramatically lower than the industry average. This focus on minimizing costs means that more of your money stays invested and working for you, which is a massive advantage for long-term compounding growth. Second is the alignment with a proven, long-term strategy. Vanguard's platform is intentionally designed to encourage discipline, buy and hold investing. It's not built for fast-paced, speculative trading. It promotes a philosophy that has historically been one of the most reliable ways to build wealth. This can be a huge benefit for beginners, as it steers them away from common mistakes like trying to time the market or chasing hot stocks. Third is the quality of its core products. Vanguard's ETFs and index funds are considered the gold standard in the industry. Products like the Vanguard S&P 500 ETF, ticker symbol VO, or the Vanguard Total Stock Market ETF, ticker symbol VTI, are cornerstones of millions of investment portfolios. They offer broad diversification in a single, easy-to-understand, and incredibly low-cost package. Finally, for those who prefer a completely hands-off approach, Vanguard offers its personal advisor services. This is a hybrid robo-advisor that combines automated portfolio management with access to a team of human financial advisors. While this service has a minimum investment requirement and an advisory fee, it's a very popular option for those who want personalized guidance. Section 3. The cons: potential downsides for beginners. While Vanguard's philosophy is powerful, the platform itself can present some challenges, especially for those accustomed to modern, sleek apps. The most common criticism is aimed at the user experience. Both the Vanguard website and mobile app are often described as functional but clunky. Compared to the intuitive design of Robinhood or the polished interface of Fidelity, Vanguard's platform can feel dated and less user-friendly. Navigating the site to find information or execute trades can have a steeper learning curve for a true beginner. Another potential drawback is the focus away from active trading. The platform is not built for speed. It lacks the sophisticated charting tools, real-time data streams, and complex order types that frequent traders rely on. This is a deliberate design choice to align with their philosophy, but it means Vanguard is a poor fit for anyone interested in day trading or more active investment strategies. Finally, customer service has received mixed reviews. While service is generally regarded as professional, some users have reported long wait times and difficulty getting quick resolutions, particularly during periods of high call volume. Section 4, a look at the costs and features. Like its major competitors, Vanguard offers commission-free online trading for stocks and ETFs. There are no account maintenance fees if you sign up for electronic delivery of statements, which is a simple setting to enable. The real cost savings, as we've discussed, are in the rock-bottom expense ratios on their own funds. This is a small annual percentage fee that every fund charges to cover its operating costs, and it's where Vanguard truly excels. It's also important to note that while Vanguard doesn't offer fractional shares of individual stocks like Fidelity does, you can purchase fractional shares of all Vanguard ETFs. This allows you to invest with as little as $1, ensuring that even beginners can start building a diversified portfolio right away. Conclusion: who is Vanguard best for? So, who is the ideal investor for Vanguard? Vanguard is the perfect platform for the disciplined long-term, set-it-and-forget-it investor. If you believe in the philosophy of passive index investing, and your primary goal is to build a diversified, low-cost portfolio that you can contribute to consistently over decades, then Vanguard is arguably the best choice in the world. It is tailor-made for retirement savers and anyone whose priority is minimizing costs above all else. However, if you are looking for a sleek, modern user interface, sophisticated trading tools, or a platform that makes active trading easy and engaging, Vanguard is likely not the right fit for you. Its strength lies not in its technology, but in its unwavering commitment to a time-tested investment philosophy. In our next chapter, we'll shift gears and look at a platform designed for the exact opposite approach. An app that automates the entire process of saving and investing small amounts of money. We'll be taking a deep dive into the world of micro-investing with Acorns. Thank you for joining us. Hello and welcome back. So far in our series, we've explored platforms that represent different corners of the investing universe, from the sleek simplicity of Robinhood to the institutional power of Fidelity and the philosophical focus of Vanguard. Today, we're taking a look at an app that approaches investing from a completely different angle. It's built on a simple yet powerful question: what if you could invest without even thinking about it? This is the world of micro-investing, and its most well-known champion is Acorns. In this chapter, we'll dive into the Acorns platform, famous for its round UPS feature that invests your spare change. We will analyze its unique, automated approach to saving and investing, break down its subscription-based fee structure, and determine for whom this set-it-and-forget-it method is truly a good fit. As we always do before we begin, please remember our essential disclaimer. This chapter is for informational and educational purposes only. It is not financial advice, and we are not recommending any specific app or investment strategy. All investing involves risk, including the possible loss of principal. You should always perform your own due diligence and consider speaking with a qualified financial professional to determine what is right for your individual situation. Section 1. The Acorns concept, investing in the background. The core idea behind Acorns is to make investing effortless and automatic, removing the psychological barriers that often stop people from getting started. It's designed to help you invest small, consistent amounts of money without feeling the impact on your daily budget. The feature that made Acorns famous is Round UPS. Here's how it works. You link your primary spending accounts, like your debit and credit cards, to the app. When you make a purchase, say a coffee for $3.45, Acorns will automatically round up the transaction to the next dollar, in this case for dollars.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
That spare 55 cents is then set aside. Once your accumulated round UPS reach a $5 threshold, Acorns automatically withdraws that money from your linked bank account and invests it for you. Beyond round UPS, you can also set up recurring investments. A set amount to be invested daily, weekly, or monthly, or make one-time lump sum deposits whenever you have extra cash. The entire system is built to run in the background of your life, helping you build a saving and investing habit without conscious effort. Section 2. How Acorns invests your money. When your money is invested by Acorns, you are not picking individual stocks or funds. Instead, Acorns functions like a robo-advisor. When you sign up, you'll answer a few questions about your financial situation, income, time horizon, and risk tolerance. Based on your answers, Acorns will recommend one of its pre-built, diversified portfolios. These portfolios range from conservative, which is heavily weighted towards bonds, to aggressive, which is composed entirely of stocks. Each portfolio is constructed using a variety of low-cost exchange-traded funds, or ETFs, from well-respected issuers like Vanguard and BlackRock. This means that even with your first $5 investment, your money is spread across hundreds or even thousands of different stocks and bonds, giving you instant diversification. The app also automatically handles rebalancing your portfolio to keep its asset allocation on track and reinvest your dividends for you, making the entire process completely hands-off. Section 3. The pros, the power of automation and psychology. The greatest strength of Acorns lies in its psychology and automation. For many people, the hardest part of investing is simply getting started and staying consistent. Acorns solves this by making the process invisible. The small amounts from round UPS rarely feel like a sacrifice, which can trick your brain into saving more than you otherwise would. It helps build a crucial habit. The platform has also expanded well beyond just investing. With its different subscription tiers, Acorns now offers an all-in-one financial wellness system. This can include Acorns Later for retirement savings in an IRA, Acorns Early, a custodial account to invest for your kids, and Acorns Banking, a checking account that is fully integrated with the investing features and provides a heavy metal debit card. This integrated ecosystem simplifies your financial life by keeping everything under one roof, which can be very appealing for beginners who want a single, straightforward solution. Section 4. The cons, the crucial impact of fees. While the concept is powerful, the primary drawback of Acorns is its fee structure, and this is a critical point for beginners to understand. Unlike most robo-advisors that charge a percentage of your account balance, Acorns charges a flat monthly subscription fee. As of late 2025, their plans are tiered. The personal plan is a few dollars a month, and the family plan is more. While these amounts might sound small, they can represent a very high percentage of your portfolio if you have a small balance. For example, a $3 monthly fee on a $100 account balance is equivalent to a 3% fee for that month. Annually, that's a staggering 36% fee, which would likely erase any investment gains you might make. The fees only become cost-effective once your account balance grows to several $1,000s. For an absolute beginner starting with just their spare change, the fees can be a significant drag on performance. It is crucial to be aware of this and to supplement your round UPS with regular, recurring deposits to help your account grow to a level where the fee becomes less impactful. Without consistent contributions, your small Acorns may struggle to grow into mighty oaks. Conclusion: who is Acorns best for? So who is the ideal user for Acorns? Acorns is perfectly suited for the person who has struggled to save or invest consistently in the past. If you are a hands-off individual who wants to automate the process and build good financial habits without having to think about it, Acorns is a fantastic tool. It excels at getting people off the sidelines and into the market. It's for the person who might otherwise let that spare change disappear without a second thought. However, Acorns is likely not the best choice for the cost-conscious investor with a very small starting balance, or for anyone who wants to have more control over their specific investment choices. The platform is a closed ecosystem. You cannot pick your own stocks or ETFs. The flat fee structure means you must be committed to growing your account balance to make it worthwhile. In essence, Acorns is less of a pure investment platform and more of a powerful, automated savings and behavior-building tool. In our next chapter, we will look at another app that combines automated investing with more flexibility and control. M1 Finance. Thank you for joining us. Hello and welcome to Chapter 6. In our journey so far, we've seen platforms that are simple by design, like Robinhood, platforms that are vast and powerful, like Fidelity, and platforms that are guided by a singular philosophy, like Vanguard. We've also explored the automated, hands-off approach of Acorns. Today, we're looking at a platform that carves out a unique space right in the middle of all of these ideas. It's called M1 Finance, and it's a hybrid platform that blends the automated, portfolio-based approach of a robo-advisor with the stock-picking freedom of a traditional brokerage. In this chapter, we'll break down M1 Finance's signature, PI investing concept, explore its powerful automation features, and analyze how it gives investors a unique level of customizable control over their long-term portfolios. Our goal is to help you understand if this innovative model is the right fit for your investment style. And as is crucial for every chapter, we must begin with our standard disclaimer. This content is intended for informational and educational purposes only. It does not constitute financial, legal, or tax advice, nor is it an endorsement of any specific platform or investment. All investing carries inherent risk, including the potential for loss. Always conduct your own thorough research, and consider consulting with a licensed financial professional before making any investment decisions. Section 1. The core concept, building your PIs. The entire M1 Finance experience is built around a single, intuitive concept, the PI. A PI is simply your investment portfolio, visualized as a circle chart. Each slice of the pie represents a specific investment, either an individual stock or an ETF. You, the investor, get to decide exactly what goes into your pie and what percentage of your portfolio each slice will represent. For example, you could create a simple pie with two slices. 60% in a total stock market ETF and 40% in a total bond market ETF. Or, you could build a highly complex pie with dozens of slices, each representing an individual company stock you believe in. You can even have pies within pies, allowing for incredibly detailed organization. If you don't want to build your own pie from scratch, M1 Finance offers a large selection of expert pies. These are pre-built portfolios designed around different themes, risk tolerances, and goals, such as retirement planning or socially responsible investing. This allows beginners to start with a professionally crafted, diversified portfolio, and then customize it as their knowledge grows. This blend of do-it-yourself customization and expert guidance is what makes M1 Finance unique. Section 2. Automation and dynamic rebalancing. Once you've created or chosen your pie, M1's automation takes over. This is where the platform truly shines. Whenever you deposit new money into your account, M1 Finance automatically invests it for you according to your target percentages. But it does so intelligently using a method called dynamic rebalancing. Here's how it works. M1 identifies which of your pie slices are underweight, meaning their current value is below your target percentage. Your new money is automatically directed to buy more of those underweight slices to bring your portfolio back in line with your plan. For example, if your tech stock slice has performed well and is now overweight, and your bond slice is underweight, your new deposit will flow primarily into the bond slice. This process helps you systematically buy low, without having to think about it. It keeps your portfolio aligned with your long-term strategy, and removes the emotion and guesswork from rebalancing. It's a powerful, automated way to maintain your desired asset allocation. It's important to note you can also rebalance your entire portfolio with a single click, which would involve selling overweight assets to buy underweight ones. But the dynamic rebalancing of new deposits avoids this and potential tax consequences. Section 3. The pros, the best of both worlds. M1 Finance offers several compelling advantages for the modern investor. First and foremost is the customizable automation. No other platform blends this level of user control over portfolio construction with such powerful, hands-off automation. It's perfect for the investor who knows what they want to own, but doesn't want the hassle of manually calculating and placing trades every time they deposit money. Second is the low cost. M1 Finance is a commission-free platform for trading. There are no fees for buying or selling the stocks and ETFs in your pies. It also offers fractional shares, so every dollar you deposit is fully invested according to your targets. Third, M1 is a holistic financial platform. Beyond investing, they offer M1 Spend, a checking account, and M1 Personal Loans, an option for borrowing. This integrated approach allows you to manage your investing, spending, and borrowing all in one place. Finally, the visual pie interface is a very intuitive way to view and manage your portfolio. It gives you a clear, at-a-glance understanding of your asset allocation. Section 4. The cons, not for everyone. Despite its innovative design, M1 Finance has limitations that make it unsuitable for certain types of investors. The most significant drawback is that it is not designed for active traders. M1 Finance uses a single trade window each day. All trades for all users are executed at one specific time, typically in the morning. You cannot place trades in real time throughout the day to react to market news or price swings. This is a deliberate choice to encourage long-term, disciplined investing, but it makes the platform a non-starter for day traders or anyone who wants precise control over their trade execution price. Another point to consider is the monthly platform fee. M1 charges a modest monthly fee, currently around $3, for users with account balances under $10,000. While this fee can be waived if you meet certain criteria, like having an M1 personal loan, it's a cost that beginners with small balances need to be aware of, similar to the dynamic we discussed with Acorns. Finally, while the platform is great for stocks and ETFs, it does not offer access to other asset classes like mutual funds or options, which may be a limitation for more advanced investors down the line. Conclusion: who is M1 Finance best for? So who is the ideal user for M1 Finance? M1 Finance is perfectly suited for the long-term, strategic investor who wants to build and automate a custom portfolio. If you are someone who enjoys the research process and wants to handpick your own stocks and ETFs, but also wants the platform to handle the day-to-day management and rebalancing automatically, M1 Finance is an exceptional choice. It empowers you to be the architect of your portfolio, while it acts as the automated construction crew. However, if you are an active trader who needs to execute trades at specific times and prices, or if you are an investor who wants the absolute simplest, hands-off approach of a pure robo-advisor without any customization, there are better platforms available. M1 Finance successfully created a new category of investing platform, one that offers a powerful combination of control and convenience. In our next chapter, we will turn our attention to the world of socially responsible and impact investing by exploring a platform called Stash. Thank you for joining us. Hello and welcome back. In our series so far, we've covered a range of platforms, each with a unique approach to helping beginners enter the world of investing. We've seen apps that prioritize simplicity, automation, and long-term, low-cost strategies. Today, we're exploring a platform that adds another layer to the decision-making process: your personal values. We are talking about Stash, an app designed not just to help you invest, but to help you invest in companies and themes that you believe in. In this chapter, we'll examine Stash's unique approach to guided stock and ETF picking, its innovative stock-back rewards program, and how it empowers beginners to build a portfolio that reflects their personal convictions. We'll weigh the pros and cons to help you decide if this values-driven approach is the right one for you. And before we proceed, it is essential to state our standard disclaimer. The content of this chapter is for informational and educational purposes only. It is not financial, legal, or tax advice. We are not endorsing any specific platform or investment. All investing involves risk, including the potential for loss of your principal. Please conduct your own thorough research and consider consulting with a qualified financial professional to guide your personal investment decisions. Section 1. The Stash Philosophy: Guidance, not just automation. Stash occupies a unique middle ground between a do-it-yourself brokerage and a fully automated robo-advisor. While platforms like Acorns and Fidelity go make all the investment decisions for you based on a risk profile, Stash takes a more educational and guided approach. It aims to empower beginners to make their own investment choices by simplifying the process and framing it in a way that's easy to understand. Instead of presenting you with thousands of cryptic stock tickers, Stash curates a wide selection of individual stocks and ETFs and groups them into descriptive, thematic categories. You might see themes like clean and green for renewable energy companies, delicious dividends for companies with a history of paying dividends, or women who lead for funds that invest in companies with strong female leadership. This approach helps beginners connect with their investments on a more personal level. It reframes the question from "what should I invest in?" to "what do I want my money to support?" This educational framework is the core of the Stash experience, designed to help you learn by doing. Section 2. The key features: themed investing and stock-back rewards. The primary feature of Stash is its guided, themed investing. You can browse through dozens of these curated themes and individual stocks, read simple, plain English descriptions of what they are, and decide which ones align with your goals and values. Stash also provides access to fractional shares, so you can start investing in any of these themes or individual companies with as little as $1. Another innovative feature is the stock-back card. Stash offers an integrated banking account with a debit card that doesn't earn cash back or points. It earns you stock. When you use your Stash debit card to make a purchase at a publicly traded company, you earn a small piece of that company's stock. If you shop at a business that isn't publicly traded, you earn a piece of a diversified stock fund. This creates a direct and tangible link between your everyday spending and your investment portfolio, reinforcing the concept of ownership in the companies you support. Like many of its competitors, Stash also offers automated features like Auto Stash, which allows you to set up recurring investments, and a roundup feature to invest your spare change, similar to Acorns. For users who do want a completely hands-off approach, Stash has also introduced Smart Portfolios, a managed portfolio option that functions like a traditional robo-advisor. Section 3. The pros: empowerment and education. The biggest advantage of Stash is its ability to empower and educate new investors. By presenting investments in an understandable, thematic way, it demystifies the stock market and helps beginners build the confidence to create their own portfolios. It's a great platform for learning by doing, with the safety net of fractional shares to keep the initial risk low. The Stockback card is another major pro, as it seamlessly integrates the habit of investing into your daily life. It's a powerful psychological tool that constantly reinforces the idea of ownership. Stash also offers a full suite of financial products, including a retirement account, IRA, and custodial accounts for children, UGMA/UTMA accounts, allowing you to manage your family's financial life within a single platform. The flexibility to choose between building your own portfolio and using an automated smart portfolio provides a great deal of choice for users with different levels of comfort and experience. Section 4. The cons: the impact of fees and limited tools. Similar to Acorns and M1 Finance, a significant drawback for Stash is its subscription-based fee structure. Stash charges a flat monthly fee for its different tiers of service. As we discussed in previous chapters, this type of fee can be very costly for accounts with small balances. A monthly fee of just a few dollars can represent a very high percentage of a small portfolio, potentially negating your investment returns. The platform only becomes cost-effective once your account balance has grown significantly. Another potential con is that while Stash provides great guidance for beginners, it lacks the advanced research tools and data of a full-service brokerage like Fidelity. As your knowledge grows, you may find the simplified descriptions and lack of in-depth analytical tools to be limiting, requiring you to seek out external resources to make more advanced investment decisions. Finally, it's important to understand that while thematic investing is engaging, it does not guarantee performance. An investment theme that aligns with your values may or may not be a good financial investment at any given time. It's still crucial to maintain a diversified, long-term perspective. Conclusion: who is Stash best for? So, for whom is Stash the ideal platform? Stash is an excellent choice for the beginner who is curious and eager to learn, but still wants guidance and a simplified experience. If you are a values-driven individual who wants your investment portfolio to be a reflection of your personal beliefs, and you enjoy the idea of actively choosing the companies and themes you support, Stash provides a fantastic framework for doing so. It's for the person who wants to be more hands-on than a pure robo-advisor, but less overwhelmed than they would be on a traditional brokerage platform. However, Stash is likely not the best fit for the highly cost-sensitive investor who is starting with a very small amount of money, as the monthly fee can be a significant hurdle. It is also not suited for advanced investors who require sophisticated research tools and data to perform their own in-depth analysis. Stash has successfully created a platform that makes investing personal and accessible. In our next chapter, we will shift our focus to a platform that caters to a more active, and often more speculative, type of investor by exploring the world of Webull. Thank you for joining us. Hello and welcome back. In our journey through the landscape of investment apps, we have explored platforms built for simplicity, for long-term philosophy, and for values-based investing. Today, we're shifting gears to examine a platform that has gained immense popularity by catering to a different type of user: the active and technically focused investor. We are talking about Webull. Positioned as a direct competitor to Robinhood, Webull offers a commission-free trading experience, but packs it with a surprisingly deep set of advanced tools, charts, and data. In this chapter, we will dissect the Webull platform. We'll explore its powerful analytical features, its fantastic paper trading simulator, and its vibrant community. We'll weigh the pros and cons to understand who this feature-rich platform is truly designed for, and whether it's a suitable starting point for a brand new investor. As always, we must begin with our critical disclaimer. This content is provided for educational and informational purposes only. It is not financial, legal, or tax advice, and it is not a recommendation to use any platform or engage in any specific trading strategy. All investing and trading involve significant risk, and you can lose money. Please conduct your own comprehensive research and consider consulting with a qualified financial professional before making any financial decisions. Section 1. What is Webull? More data, more tools. Webull entered the US market with a clear mission: to offer a sophisticated, high-tech trading experience without the high costs typically associated with such platforms. Like many modern brokerages, it offers commission-free online trading of stocks, ETFs, and options. But where it immediately differentiates itself is in the sheer volume of information and analytical tools it provides to its users free of charge. The platform is built for analysis. It offers robust and highly customizable charting with dozens of technical indicators, drawing tools, and different chart styles. Users can access in-depth market data, including Level 2 quotes, which show the real-time bids and asks for a stock, giving you a deeper look at market supply and demand. You can create complex order types, analyze a company's financial statements, and track analyst ratings, all from within the app. Webull is available on mobile, web, and a downloadable desktop platform, ensuring a seamless experience for traders who want access to their tools from anywhere. Section 2. The Pros, a Trader's Toolkit for free. Webull offers a number of compelling advantages, especially for those who want to move beyond simple buy-and-hold investing. First and foremost are the advanced trading tools. The quality and depth of Webull's charting software and analytical features are comparable to what you might find on professional-grade, paid platforms. For anyone interested in learning or applying technical analysis, the practice of using chart patterns and statistical indicators to forecast price movements, Webull provides a complete toolkit at no cost. Second is the outstanding paper trading simulator. This is a massive benefit for beginners. Webull's paper trading feature gives you a virtual account funded with a large amount of practice money. You can use this to test out trading strategies, learn the mechanics of placing different order types, and get comfortable with the platform's features using real-time market data, all without risking a single penny of your actual money. This is an invaluable educational tool. Third is the access to extended hours trading. Webull offers some of the longest pre-market and after-hours trading sessions available, running from 4 a.m. to 8 p.m. Eastern Time. This allows more active traders to react to news and earnings announcements that happen outside of the standard market day. Finally, Webull has a built-in community feature, where users can comment on specific stocks, share their analysis, and see what other traders are thinking. While this should be approached with caution, it can be a useful way to gauge market sentiment and discover new ideas. Section 3. The cons: is it too much for a beginner? While Webull's features are a major strength, they also contribute to its biggest potential drawback for new investors. The primary con is that the platform can be incredibly overwhelming. The sheer amount of data, charts, and terminology can lead to analysis paralysis for someone who is just starting out. Unlike the minimalist design of Robinhood, Webull's interface is packed with information. This steep learning curve can be intimidating and might even encourage new users to engage in complex trading strategies before they fully understand the risks involved. Another point to consider is that Webull, like Robinhood, primarily generates revenue through payment for order flow (PFOF). As we've discussed, this is a practice where the brokerage is paid by market makers to execute your trades, creating a potential conflict of interest that has drawn regulatory scrutiny. Furthermore, while Webull excels at providing tools for trading stocks and options, it does not offer access to other common investment types, such as mutual funds or bonds. This makes it less suitable for building a traditional, diversified, long-term portfolio compared to a full-service brokerage like Fidelity or Vanguard. The focus is clearly on active trading, not comprehensive wealth management. Section 4. Understanding the costs. Webull's pricing is very competitive. It offers $0 commission on US-listed stocks, ETFs, and options. It is important to know that while there's no commission on options trades, there are still small, unavoidable regulatory and exchange fees on a per-contract basis. There are no account maintenance fees or fees for standard electronic deposits and withdrawals. The platform's powerful tools, data, and paper trading simulator are all provided for free. The primary costs for users would come from things like wire transfer fees or interest on margin loans, should you choose to trade with borrowed funds, a high-risk strategy not recommended for beginners. Conclusion: who is Webull best for? So, what kind of investor is the ideal fit for Webull? Webull is an exceptional platform for the aspiring or experienced active trader who wants access to professional-grade tools without the professional-grade price tag. It is perfect for the data-driven investor who is interested in technical analysis, options trading, and short-term market movements. The paper trading feature also makes it a fantastic, risk-free educational environment for anyone who wants to learn these more advanced skills. However, Webull is likely not the best starting point for a true beginner whose goal is to build a simple, long-term, buy-and-hold portfolio. The overwhelming interface and the focus on active trading can be a distraction from the core principles of long-term investing. For that type of investor, a platform like Fidelity or Vanguard might be a more appropriate and less distracting choice. Webull has successfully carved out a niche by empowering retail traders with tools that were once the exclusive domain of Wall Street. In our next chapter, we'll look at another major player in the commission-free world, an app that has been around for decades but continues to innovate for modern investors. Charles Schwab, thank you for joining us. Hello and welcome to Chapter 9. In our comprehensive tour of the investment app landscape, we have examined fintech disruptors and laser-focused specialists. Today, we turn our attention to one of the most respected and established names in the entire financial industry, Charles Schwab. For decades, Schwab has been a trusted institution for millions of investors. It has successfully navigated the modern era by embracing zero-commission trading and making a landmark move by acquiring TD Ameritrade, bringing the legendary thinkorswim trading platform into its ecosystem. In this chapter, we will explore the massive, all-in-one financial world of Charles Schwab. We'll look at its extensive investment options, its powerful platform offerings for both beginners and elite traders, its robo-advisor service, and its commitment to customer service and education. Our aim is to help you understand how this industry giant caters to nearly every type of investor, from the first-timer to the seasoned pro. As we always do, we must begin with our most important message. This chapter is for informational and educational purposes only. It is not a substitute for professional financial, legal, or tax advice. We are not endorsing any specific platform or investment strategy. All investments carry risk, including the possible loss of your money. Please ensure you conduct your own thorough research and consider speaking with a qualified financial professional. Section 1. What is Charles Schwab? A universe of financial services. Charles Schwab is far more than just a place to buy stocks. It's a complete financial services company. Alongside its brokerage accounts, it operates as a major bank, offering checking and savings accounts. It provides a vast array of investment products, retirement solutions, and wealth management services. The core principle of Schwab has always been to make investing more accessible to the average person, a mission it has pursued since the 1970s. For today's beginner, Schwab offers a compelling combination of features. There are no account minimums and no commissions on online stock and ETF trades. It provides fractional shares, which they call stock slices, allowing you to invest in S&P 500 companies with as little as $5. And it has a massive selection of low-cost Schwab-branded mutual funds and ETFs that compete directly with giants like Vanguard and Fidelity. This combination of affordability and selection makes it an incredibly strong starting point. A pivotal moment for Schwab was its acquisition and full integration of TD Ameritrade. This move brought the world-renowned thinkorswim platform under the Schwab umbrella, instantly transforming it into a powerhouse for active and technical traders as well. Section 2. The pros, a platform for every stage of your journey. The advantages of choosing a comprehensive platform like Schwab are numerous. First and foremost is the exceptional range of services and investment options. Whatever your financial goal, Schwab likely has an account and the products to help you achieve it. From standard brokerage and retirement accounts to education savings plans and trusts, it's all here. You have access to thousands of stocks, ETFs, and options, plus one of the largest selections of no-transaction fee mutual funds in the industry. Second is the outstanding customer service and educational resources. Schwab is consistently ranked at the top for customer support. You can get help 24/7 via phone or live chat, and they also operate hundreds of physical branches across the country where you can get face-to-face assistance. Their online learning center is a treasure trove of high-quality articles, videos, and live webcasts designed to help investors of all skill levels. Third is the access to powerful platforms. For most beginners, the standard Schwab website and mobile app are clean, easy to navigate, and more than sufficient. However, as your skills grow, you have a direct pathway to the thinkorswim suite of platforms: web, desktop, and mobile. thinkorswim is an elite trading platform packed with sophisticated charting tools, screeners, and a fantastic paper trading mode, giving you an incredible amount of room to grow as an investor. Finally, for those who want a managed approach, there's Schwab Intelligent Portfolios. This is Schwab's robo-advisor service that builds and manages a diversified portfolio for you. The basic version has no advisory fees, making it one of the most cost-effective managed portfolio options available. Section 3. The cons, potential challenges for newcomers. While Schwab is an excellent all-around platform, there are a few potential downsides for beginners.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Similar to Fidelity, the sheer breadth of options can be overwhelming. Navigating a platform with so many tools, account types, and investment choices can be more daunting than using a simplified, single-purpose app. A new user will need to invest some time to learn their way around the ecosystem. Another point of contention for their robo-advisor, Schwab Intelligent Portfolios, is its high cash allocation. The service deliberately holds a notable percentage of your portfolio in cash, which earns a very low interest rate. While Schwab argues this is for stability, critics point out that this cash is a source of revenue for Schwab's banking division and can be a drag on your portfolio's overall returns during strong market periods. Lastly, while the thinkorswim platform is a massive pro for traders, it has a very steep learning curve. A beginner opening thinkorswim for the first time will likely be completely intimidated by its complexity. It is a tool best reserved for once you have a solid foundation of investing knowledge. Section 4. A clear view on costs. Charles Schwab's pricing is highly competitive and transparent. For self-directed investors, online trades of U.S. stocks and ETFs are commission-free. Options trades are also commission-free, but have a standard per-contract fee of 65 cents. There are no recurring account maintenance or inactivity fees. As mentioned, the basic Schwab Intelligent Portfolios service has no advisory fees, though you still pay the underlying expense ratios of the ETFs in your portfolio, which is standard for all robo-advisors. For the premium version of the robo-advisor, which includes one-on-one access to a human financial planner, there is a one-time setup fee and a modest monthly charge. Conclusion. Who is Charles Schwab best for? So who is the ideal investor for Charles Schwab? Charles Schwab is an outstanding choice for nearly any type of U.S. investor, but it particularly shines for the beginner who wants a long-term relationship with a single, trusted financial institution. If you value excellent customer service, extensive educational resources, and a massive selection of low-cost investment products, Schwab is a top-tier option. It is a platform that you can start with on day one and never outgrow, seamlessly transitioning from simple buy-and-hold investing to more advanced trading on the thinkorswim platform if your interests evolve. However, if your absolute highest priority is a sleek, minimalist, and gamified mobile experience, a platform like Robinhood might feel more immediately engaging. And if you are considering the robo-advisor, you must be comfortable with their cash allocation strategy. Ultimately, Charles Schwab offers a potent combination of institutional trust, modern pricing, and powerful technology. In our next chapter, we will explore a platform that has built its reputation on serving the specific needs of a younger, mobile-first generation of investors. SoFi. Thank you for joining us. Hello, and welcome to Chapter 10 of our series. Thus far, we have explored a wide variety of investment platforms, from specialized trading apps to traditional, full-service brokerages. Today, we're diving into a platform that aims to be something more, a single, unified hub for your entire financial life. We are talking about SoFi, which stands for Social Finance. Originally known for student loan refinancing, SoFi has rapidly expanded into a digital banking and investment powerhouse, designed for a younger, tech-savvy generation that wants to manage their money seamlessly in one place. In this chapter, we will explore the SoFi ecosystem, focusing on its two distinct investment paths, active and automated investing. We'll also look at the powerful member benefits that come with being part of the SoFi community, and help you understand if this integrated, all-in-one approach is the right fit for your financial journey. As is essential before every discussion, we must begin with our critical disclaimer. This content is for informational and educational purposes only. It is not, and should not be considered financial, legal, or tax advice. We are not endorsing any specific platform or investment strategy. All investments involve risk, including the potential for losing your money. Always conduct your own independent research and consider consulting with a qualified financial professional. Section 1. What is SoFi? More than an investment app. SoFi's vision is to be the only financial app you need. It's a super app that combines banking, investing, personal loans, student loans, credit cards, and more into one clean, interconnected interface. The idea is that by having a holistic view of your finances, you can make smarter, more coordinated decisions. Within this ecosystem is SoFi Invest. Recognizing that beginners have different needs and comfort levels, SoFi cleverly splits its investment offering into two main paths. The first is active investing, a self-directed brokerage account where you can buy and sell stocks and ETFs with zero commission. It supports fractional shares, allowing you to get started with small amounts of money. The second path is automated investing, which is SoFi's robo-advisor service. You answer a few questions, and SoFi builds and manages a diversified portfolio of low-cost ETFs for you, with no advisory fees. This dual approach is a key part of SoFi's strategy. It provides a simple on-ramp for absolute beginners with the automated option, while also offering a direct path for them to become more hands-on investors when they feel ready. Section 2. The pros, the power of the ecosystem. The most significant advantage of SoFi is its seamless, all-in-one ecosystem. You can have your direct deposit go into your high-yield SoFi checking and savings account, pay bills, track your credit score, invest for the long term, and apply for a loan, all without ever leaving the app. This integration can simplify money management and provide a clear, comprehensive picture of your financial health. Another major pro is the exclusive SoFi member benefits. SoFi works hard to create a sense of community and reward its users. All members get complimentary, one-on-one access to certified financial planners. This is an incredibly valuable perk that would typically cost a significant amount of money elsewhere. Members also get discounts on other SoFi products, career coaching services, and even access to exclusive networking events and experiences. From a cost perspective, SoFi Invest is very competitive. Both the active and automated investing platforms are largely fee-free. There are no commissions on stock and ETF trades and no advisory fees for the robo-advisor. This low-cost structure, combined with access to free financial advice, creates a very high-value proposition for a new investor. SoFi also offers a unique 1% match on IRA contributions, providing a powerful incentive for retirement savings. Section 3. The cons, not built for the advanced investor. While SoFi excels at being a comprehensive financial hub, its individual components may not be the most powerful in their class. A primary drawback of the SoFi Invest platform is its relative simplicity. While this is great for beginners, the research tools, charting capabilities, and order types on the active investing side are very basic compared to platforms like Webull or a full-service brokerage like Schwab's Thinkorswim. As your knowledge grows, you may find the platform lacks the depth you need for more sophisticated analysis and trading. Similarly, while the automated investing service is excellent and fee-free, it doesn't offer some of the advanced features found on other robo-advisors, such as tax loss harvesting, which can be a valuable tool for optimizing tax liabilities in taxable accounts. Another point to consider is that while SoFi offers access to stocks and ETFs, it has a more limited range of investment options overall. You won't find mutual funds or bonds on the platform, which could be a limitation for those looking to build a more traditionally diversified portfolio. It's important to note that after a brief pause, SoFi has reintegrated cryptocurrency trading back into its platform. Section 4. A clear view on costs. SoFi's fee structure is one of its most attractive features. For SoFi Invest, the costs are minimal. Active investing. $0 commissions for online trades of stocks and ETFs. Automated investing. $0 in advisory fees. You only pay the underlying expense ratios of the ETFs in your portfolio, which is standard across the industry. Account fees. SoFi has no account maintenance fees, though like most brokers, there are charges for specific actions like outgoing account transfers. The primary way SoFi monetizes is through its other products, like the interest it earns on loans and cash balances. This business model allows them to offer the investment side of their platform at an extremely low cost to the user. Conclusion: who is SoFi best for? So, what kind of person is the ideal SoFi member? SoFi is perfectly suited for the digitally savvy beginner, particularly millennials and Gen Z, who want to consolidate their entire financial life into a single, easy-to-use app. If you value the convenience of an integrated ecosystem and plan to use other financial products like high-yield savings or a credit card, the member benefits, especially the free access to financial planners, make SoFi an incredibly compelling choice. It's for the person who wants a one-stop shop for their money. However, if you are an aspiring active trader or a serious investor who requires advanced tools, in-depth research, and a wide array of investment products, SoFi Invest will likely feel too basic for your needs. Its strength lies in its breadth and integration, not in the depth of its individual investing tools. SoFi represents the future of personal finance, where the lines between banking, borrowing, and investing are blurred into one seamless user experience. In our next chapter, we will look at a platform that takes a very different, highly visual, and mobile-native approach to investing, Public.com. Thank you for joining us. Hello and welcome to Chapter 11. Our journey has taken us through a diverse array of investment platforms, each with its own philosophy on how to best serve the modern investor. Today, we're exploring a platform that is built on the idea of transparency and community. It's called Public.com, and it has reimagined the investing app as a social network, where users can share ideas, follow expert investors, and build their financial literacy together in the open. In this chapter, we will dive into the unique social investing experience of Public.com. We'll examine its community-first features, its innovative business model that rejects payment for order flow, and its expansion into alternative assets. Our goal is to give you a clear understanding of what it means to invest within a community, and whether this transparent approach is the right one for you. As we always do, we must start with our crucial disclaimer. The information provided in this chapter is for educational and informational purposes only. It does not constitute financial, legal, or tax advice. We are not endorsing any specific platform, investment, or strategy. All investing involves risk, including the potential loss of your principal. It is essential to conduct your own thorough research and consider consulting with a qualified financial professional. Section 1. What is Public.com? The social investing network. At its core, Public.com is a multi-asset investment platform. You can buy and sell stocks, ETFs, options, bonds, and cryptocurrencies, all with a low minimum investment thanks to fractional shares. But what truly sets Public apart is its integrated social feed. It's like a social media platform and a brokerage app rolled into one. When you sign up, you create a profile, and your trades can be shared with the community. You can follow friends, experienced investors, and financial creators to see what they are investing in, and read the rationale behind their decisions. This creates a real-time stream of ideas and discussions. You can comment on trades, ask questions, and participate in a broader conversation about the markets. The platform also organizes investments into intuitive themes, like the AI revolution or sustainable business, making it easy for beginners to discover companies aligned with their interests. A key part of Public.com's identity is its business model. It was one of the first platforms to publicly reject the controversial practice of payment for order flow, or PFOF, for stock and ETF trades, which we have discussed in previous chapters. This was a major move designed to build trust and align the company's interests more closely with those of its users. Section 2. The pros: transparency, community, and alternatives. The most significant advantage of Public.com is its community and educational focus. For a beginner, the process of investing can feel isolating and confusing. Public.com's social feed transforms it into a collaborative experience. Seeing the moves and thoughts of more experienced investors can be a powerful learning tool, helping you discover new companies and understand different investment theses. The platform also hosts town halls, which are live Q&A sessions with the CEOs of publicly traded companies, giving you direct access to leadership. Another major pro is the transparent business model. By rejecting PFOF, Public.com routes your trades directly to the exchanges. They aim to make money through other means, including an optional tipping feature on trades, a premium subscription service, interest on cash balances, and fees on more advanced products. This model is designed to reduce the potential conflicts of interest that we've discussed with other platforms. Finally, Public.com has expanded into alternative assets. This is a unique feature that allows you to invest in fractional shares of things like fine art, royalties, and collectibles. While these are higher-risk, speculative investments not typically recommended for a core portfolio, it gives users access to an entirely different set of asset classes that were once only available to the ultra-wealthy. Section 3. The cons: the dangers of social influence and costs. While the social features are a major draw, they also represent the platform's biggest potential pitfall. The primary con is the risk of herd mentality and social influence. It can be very tempting for a new investor to simply copy the trades of a popular user without doing their own research or considering if that investment fits their own risk tolerance and financial goals. This can lead to impulsive decisions based on hype rather than sound financial principles. It is absolutely critical for users on a social platform to remember that what is right for someone else's portfolio may not be right for theirs. Another point to consider are the costs. While standard stock trades are commission-free, public.com does have fees for certain services. For example, their recurring investment plan feature carries a small transaction fee. They also offer Public Premium, a subscription that unlocks advanced data, research tools, and fee-free extended hours trading. While valuable, this is an added cost that investors need to be aware of. Finally, while the platform is very user-friendly, its research tools are not as deep or powerful as those found on a full-service brokerage like Fidelity or Schwab. An investor who wants to perform deep, technical analysis may find the tools on public.com to be too basic for their needs. Section 4. A clear view on the business model. Public.com's business model is a key differentiator. Without PFOF for equities, how do they make money? Optional tipping. When you place a trade, you have the option to leave a small tip to help support the platform. This is entirely voluntary. Public Premium. A monthly or annual subscription that offers advanced features for a fee. Other services. They earn revenue from interest on cash balances, fees on alternative asset trades, and other services in their ecosystem. This model is designed for transparency, but it's important for users to understand that commission-free doesn't always mean cost-free. Conclusion. Who is public.com best for? So who is the ideal investor for public.com? Public.com is an excellent platform for the curious, community-oriented beginner who wants to learn by observing and interacting with others. If you enjoy the social media experience and believe that transparency is important, public.com's unique model and community features can make investing a more engaging and less intimidating process. It's for the person who wants to see the why behind the what of an investment. However, if you are an investor who is easily swayed by popular opinion or is prone to making impulsive decisions based on hype, the social feed could be a dangerous distraction. It is also less suitable for a highly data-driven, technical trader who requires sophisticated charting and analysis tools. Public.com offers a bold and modern take on what an investment platform can be. In our next chapter, we will consolidate everything we've learned and provide a framework for how you can choose the absolute best app for your personal financial journey. Thank you for joining us. Hello and welcome to Chapter 12. Over the past 11 chapters, we have taken a deep and comprehensive dive into the world of modern investment apps. We've explored platforms built for every type of beginner, from the hands-off automated investor to the hands-on active trader. We've seen the strengths of industry giants and the innovations of agile startups. Now we arrive at the most important part of this entire series, putting all that knowledge into action to help you make a confident, personal choice. In this chapter, we will not be recommending one single best app. Instead, we will provide you with a clear framework of questions to ask yourself. We'll revisit the core strengths of the platforms we've discussed and categorize them based on different investor profiles. The goal of this chapter is to empower you to match your unique financial goals, personality, and learning style with the platform that is truly the best fit for you. And as we begin this critical discussion, we must reinforce our most important message one more time. This framework is for educational and informational purposes only. It is not financial advice. The choice of a brokerage platform is a personal one, and the right answer depends entirely on your individual circumstances. All investing involves risk. We strongly encourage you to use this guide as a starting point for your own research, and to consider consulting with a qualified financial professional. Section 1. The 4 key questions to ask yourself. Choosing an investment app can feel overwhelming, but you can bring clarity to the decision by honestly answering 4 fundamental questions. Grab a pen and paper, and let's walk through them. Question 1. What is my primary goal for investing right now? Are you trying to build a set-it-and-forget-it retirement fund that you won't touch for 40 years? Are you saving for a down payment on a house in the next 5 to 7 years? Or are you simply curious about the stock market and want to learn by actively trading with a small amount of money? Your goal dictates your strategy, and your strategy will point you toward the right tool. Question 2. How involved do I want to be? Be honest about your personality and your available time. Do you want a completely hands-off, automated experience where you never have to think about making a trade? Or do you enjoy research and want to be the one picking every single stock and ETF in your portfolio? Or maybe you want a hybrid approach, the ability to choose your investments but have the platform automate the maintenance. This is the spectrum from do it for me to do it myself. Question 3. How do I learn best? Think about your learning style. Do you learn by reading in-depth research reports and articles? Do you prefer a hands-on approach, learning by doing in a practice environment? Or do you learn best in a social, community-driven setting where you can see what others are doing and ask questions? Different platforms cater to different learning styles. Question 4. How sensitive am I to costs and complexity? Are you starting with a very small amount of money, where a flat monthly fee could significantly impact your returns? Or are you more concerned with having the most powerful tools, even if they come with a steeper learning curve? Understanding your sensitivity to both financial costs and the mental cost of complexity is crucial. Section 2. Matching your profile to a platform. Now that you've reflected on those questions, let's categorize the apps we've discussed to see where you might fit. Profile 1. The set-it-and-forget-it hands-off investor. Your answers. Your goal is long-term growth, like retirement, and you want a completely automated, do-it-for-me experience. You are not interested in picking stocks. Top contenders. Vanguard, the champion of this philosophy. Ideal if you want to build a portfolio of their world-class, low-cost index funds and ETFs and let it grow for decades. Acorns. Perfect if you struggle to save. It automates investing your spare change, building the habit for you. Just be mindful of the monthly fee on small balances. SoFi Automated Investing / Schwab Intelligent Portfolios. Excellent, fee-free robo-advisors integrated into larger financial ecosystems. Great if you want automated management with the backing of a major institution. Profile 2. The eager and engaged learner. Your answers. Your goal is to learn how the market works while you build a long-term portfolio. You want a do-it-myself experience but with strong educational support. Top contenders. Fidelity / Charles Schwab. The undisputed leaders here. They offer a universe of investment choices, zero commissions, fractional shares, and most importantly, world-class educational centers and research tools. They are platforms you will never outgrow. Public.com. A great choice if you learn best in a social setting. You can see what others are investing in and why, turning the learning process into a community experience. Profile 3. The aspiring active trader. Your answers. You are fascinated by market dynamics and want to learn technical analysis and active trading strategies. You need powerful tools and a way to practice without risk. Top contenders. Webull, the clear frontrunner. It offers professional-grade charting and data for free, along with an outstanding paper trading simulator to practice your skills risk-free. Schwab, with thinkorswim, the ultimate upgrade path. Start with Schwab's user-friendly main platform, and then graduate to the elite power of thinkorswim when you are ready, all under one account. Profile 4. The modern mobile-first user. Your answers. You value simplicity, a sleek user interface, and the ability to manage your finances easily from your phone. Top contenders. Robinhood, the pioneer of the simple, mobile-first experience. It's an incredibly easy way to start buying and selling stocks and ETFs. SoFi, the ultimate super app. If you want to seamlessly integrate your investing with your banking and other financial products in one clean interface, SoFi excels. M1 Finance. Perfect for the user who wants custom control combined with mobile-first automation through its intuitive Pi investing system. Conclusion. Trust your judgment. There is no single right answer, and the great news is that you are not locked in forever. Most of these platforms have no cost to open or maintain an account. You can start with one, and if your needs change, you can always transfer your assets to another brokerage down the road. The most important step is the one you are taking right now: educating yourself. By understanding your own goals and personality, you can cut through the marketing noise and choose a platform that will serve as a powerful ally on your journey to financial empowerment. In our next chapters, we will walk through the practical steps of opening your account and placing your very first investment. Thank you for joining us. Hello and welcome to Chapter 13. In our last chapter, we created a framework to help you choose the investment app that best aligns with your personal goals and style. Now, it's time to move from theory to practice. This chapter is a practical, step-by-step guide to the next phase of your journey: opening your account, funding it, and placing your very first trade. The process can seem formal and a bit intimidating, but we're going to demystify it for you. We'll walk through the information you'll need, the choices you'll make, and the mechanics of that exciting first investment. Our goal today is to give you the confidence to navigate the account setup process and understand exactly what's happening when you click that buy button for the first time. And as we discuss these practical steps, it is absolutely essential to reinforce our core disclaimer. This chapter provides a general overview of the account opening and trading process. It is for informational and educational purposes only, and is not financial advice. The specific investment choices discussed are for illustrative purposes only and are not recommendations. All investing involves risk. Always ensure you have done your own research and are making decisions that are appropriate for your individual financial situation. Section 1. The paperwork. What you'll need to open an account. Opening a brokerage account in the United States is a standardized and regulated process. To comply with federal law, including the Patriot Act, brokerage firms are required to verify the identity of their clients. While the interface will look different on each app, the information you'll be asked to provide is virtually the same everywhere. To make the process smooth and quick, it's a good idea to have this information handy before you start. You will need your Social Security number or taxpayer identification number. This is non-negotiable for tax reporting purposes. A valid government-issued photo ID. This is typically your driver's license or passport. Some apps may ask you to take a photo of it with your phone. Your legal residential address. This cannot be a P.O. box. Your date of birth and contact information, like your phone number and email address. Your employment status and affiliation. You'll be asked for your employer's name and address. You will also be asked if you or a family member is a high-level executive or a 10% shareholder of a publicly traded company, which is a regulatory question. Basic financial information. You'll be asked to provide your approximate annual income and net worth. Don't worry, you don't need to be wealthy to open an account. This information helps the brokerage understand your financial profile to meet what's known as the suitability rule. The entire online application process usually takes about 10 to 15 minutes. Section 2. Choosing your account type. Individual versus retirement. During the setup process, one of the first and most important choices you'll make is the type of account to open. For a beginner, this usually comes down to two main categories. The first is a standard individual brokerage account, sometimes called a taxable brokerage account. This is a general-purpose account with no special tax rules. You can deposit and withdraw money at any time, and you can invest in a wide range of assets. The key thing to remember is that any profits you make, from selling an investment for more than you paid for it or from receiving dividends, are typically subject to taxes in the year they are realized. The second category is an individual retirement account, or IRA. These accounts are specifically designed for long-term retirement savings and come with powerful tax advantages. The two most common types are the traditional IRA, where your contributions may be tax-deductible now, and a Roth IRA, where you contribute with after-tax money, but your qualified withdrawals in retirement are completely tax-free. IRAs have annual contribution limits set by the government, and there are rules about when you can withdraw the money without penalty. For many beginners focused on long-term goals, opening a Roth IRA is a fantastic first step. Section 3. Funding your account. Once your account is approved, which is often instantaneous, you need to add money to it. The most common and easiest way to do this is through an ACH transfer from your bank account. ACH stands for Automated Clearing House, which is the electronic network for financial transactions in the United States. You will be prompted to link a bank account to your new brokerage account. Most apps use a secure service like Plaid to instantly verify your bank account by having you log in with your online banking credentials. Once linked, you can initiate a transfer. It's important to know that while some apps give you instant buying power, the actual cash can take 3 to 5 business days to fully settle in your account before you can withdraw it again. Section 4. Placing your first trade, market versus limit orders. You've opened your account, funded it, and now you're ready to buy your first investment. Let's say, for example, you want to buy a share of a popular S&P 500 ETF. When you go to the trade screen, you'll need to specify two things: how many shares you want to buy, and what type of order you want to place. The two most common order types for beginners are the market order and the limit order. A market order is the simplest. It tells the brokerage, buy this for me right now at the best available price. It is almost guaranteed to execute instantly as long as the market is open. The advantage is speed. The disadvantage is that you don't have precise control over the price. The price you actually pay, called the execution price, might be slightly different from the price you saw a second before you clicked the button. For large, heavily traded ETFs and stocks, this difference is usually negligible. A limit order gives you more control. It tells the brokerage, buy this for me only if the price is at or below this specific price I am setting. For example, if a stock is trading at $100.50, you could set a limit order to buy at $100. Your order will only execute if the price drops to $100 or lower. The advantage is that you control the price you pay. The disadvantage is that if the price never drops to your limit, your order may never be filled. For a beginner making their first long-term investment in a major ETF, a market order is often perfectly fine. But understanding limit orders is a crucial step in becoming a more sophisticated investor. Conclusion: you've done it. And that's it. Once your order is executed, you are officially an investor. You own a small piece of the market. The process might feel technical, but each step is logical and designed to be secure. The key is to take your time, read each screen carefully, and understand the choices you are making. In our next chapter, we'll discuss what to do after you've made your first investment, focusing on the basics of building a simple portfolio.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
And the mindset you'll need for long-term success. Thank you for joining us. Hello and welcome to Chapter 14. In our last chapter, you took the pivotal step of opening your account and making your first investment. Congratulations! You are now officially an owner of a piece of the market. But just as planting a seed is only the beginning of gardening, making your first investment is only the beginning of your wealth-building journey. What you do next, and more importantly, how you think next, will determine your long-term success. In this chapter, we will focus on the two crucial elements of nurturing your new investment: the practical basics of building a simple portfolio, and the psychological discipline required to be a successful long-term investor. We'll discuss key concepts like diversification and consistency, and we'll arm you with strategies to overcome the common emotional traps that derail so many beginners. As we delve into these important concepts, it is paramount that we reiterate our core disclaimer. This chapter provides general educational and informational guidance on portfolio and mindset principles. It is not financial advice. The examples used are for illustrative purposes only and do not constitute investment recommendations. All investing involves risk. It is essential to make decisions based on your own research and personal financial situation. Section 1. The first principle: diversification. Now that you own your first stock or ETF, your next thought might be, what should I buy next? Before you do anything, the most important concept to embrace is diversification. We've touched on this before, but it's the bedrock of sound investing. It's the simple principle of not putting all your eggs in one basket. If you bought a single company's stock as your first investment, you've taken on what is called concentrated risk. Your success is tied entirely to the fortunes of that one company. A more prudent approach for a core portfolio is to spread your investment across many different companies and industries. For beginners, the easiest and most effective way to achieve instant diversification is through low-cost, broad market exchange-traded funds, ETFs. For example, an S&P 500 ETF gives you a piece of the 500 largest companies in the United States. A total stock market ETF goes even broader, giving you ownership in thousands of U.S. companies, both large and small. An international stock market ETF can diversify your holdings geographically, giving you a stake in companies across Europe, Asia, and other developed and emerging markets. By combining a few of these simple, low-cost ETFs, you can build a globally diversified portfolio with just a handful of investments. This approach protects you from the risk of any single company failing and allows you to capture the growth of the global economy as a whole. Section 2. The second principle: consistency. The second key to long-term success is consistency. Wealth is rarely built through a single, brilliant investment. It is most often built through the disciplined, consistent habit of investing money over time, month after month, year after year. This is a strategy known as dollar-cost averaging. It's the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing. For example, you might decide to invest $100 on the first of every month. When the market is up, your $100 will buy fewer shares. When the market is down, that same $100 will buy more shares. Over time, this strategy smooths out your average purchase price and, more importantly, it automates the process. It removes the emotion and guesswork of trying to time the market. That is, trying to buy at the absolute bottom and sell at the absolute top, which is a game that even most professionals cannot win consistently. Setting up automatic, recurring investments is one of the most powerful actions you can take as a new investor. Section 3. Managing your mindset, the hardest part. Once you have a simple, diversified portfolio and a plan for consistent contributions, the biggest challenge is no longer about numbers or charts. It's about managing your own emotions. Here are the most common psychological traps and how to avoid them. 1. the urge to constantly check your account. In the beginning, it's exciting to watch your balance change. But checking your portfolio every day, or even every hour, is a recipe for anxiety. The market fluctuates constantly. This is normal. Obsessively watching these short-term movements can lead to emotional, impulsive decisions. Commit to checking your long-term portfolio far less frequently. Perhaps once a month or even once a quarter. 2. Fear of missing out. FOMO. You will inevitably hear stories about a hot stock or cryptocurrency that has skyrocketed in value. This can trigger a powerful fear of missing out, tempting you to abandon your long-term strategy and chase quick profits. This is a dangerous form of speculation, not investing. Stick to your plan. A disciplined, boring plan is almost always more profitable in the long run than chasing hype. 3. Panic selling during a downturn. The market will go down. This is not a matter of if, but when. Seeing the value of your portfolio drop can be terrifying for a new investor. The primal urge is to sell everything to stop the bleeding. This is almost always the worst possible thing you can do. Selling after a drop just locks in your losses. Market downturns are a normal part of the economic cycle. A long-term investor understands this and has the fortitude to stay invested, continuing their regular contributions, knowing that historically, the market has always recovered and gone on to reach new highs. Conclusion: trust the process and be patient. Your job as a new investor is not to be a market genius. Your job is to create a simple, sensible plan, automate it, and then have the patience and discipline to let it work for you over a very long period. Focus on what you can control: your savings rate, your consistency, your diversification, and your own behavior. Let the market do the rest. The power of compounding is a slow, quiet force. Nurture it with consistency and protect it from the corrosive effects of fear and greed. In our final chapter, we will look to the future, discussing how to review your progress, set new goals, and continue your journey of financial education. Thank you for joining us. Hello, and welcome to the final chapter of our series. You have come an incredibly long way. From taking that first courageous step to learn about investing, to choosing a platform, opening an account, and building a foundational portfolio, you have laid the groundwork for a stronger financial future. This is a monumental achievement, and you should be proud. But our journey doesn't end here. It simply evolves. Investing isn't a race with a finish line. It's an infinite game of growth, learning, and adaptation. In this concluding chapter, we will look forward. We'll discuss how to conduct a simple annual checkup on your portfolio, where to turn for continued education, and how to set the stage for the next phase of your financial life. This is about solidifying the habits and mindset that will serve you for decades to come. And for the last time, it is vital that we begin with our most important and unwavering disclaimer. This content is for informational and educational purposes only. It is not financial, legal, or tax advice. We are not investment advisors. The principles discussed are general in nature and may not be suitable for your specific circumstances. All investing involves risk. Please continue to do your own research and always consider consulting with a qualified financial professional. Section 1. The Annual Checkup, a simple review. In our last chapter, we warned against the dangers of checking your portfolio too frequently. However, a deliberate, scheduled check-in is a healthy and responsible habit. For most long-term investors, a simple annual checkup is sufficient. This isn't a time to panic about performance, but to calmly review and realign. Here's a simple checklist for your annual review. Review your goals. Have any of your major life goals changed? Are you still on the same timeline for retirement or that down payment? Your investments are tools to serve your life, so a quick check to ensure they are still aligned with your life's direction is the most important first step. Check your asset allocation. Look at your portfolio's current mix of assets. Let's say you started with a target of 80% stocks and 20% bonds. After a strong year for stocks, your portfolio might have drifted to be 85% stocks. This is a good time to consider rebalancing. Rebalancing simply means trimming some of the assets that have done well, selling 5% of your stocks, and reallocating that money to the assets that are underweight, buying more bonds, to get back to your original target. This enforces a disciplined buy low, sell high strategy and manages your risk. Many robo-advisors do this for you automatically. Assess your contributions. Were you able to invest as consistently as you planned? Can you afford to increase your automatic contributions for the coming year? Even a small increase can make a huge difference over the long term. Notice what is not on this list. Agonizing over whether your portfolio beat the market last year. Short-term performance is largely noise. The goal of this checkup is to ensure your plan is still sound and you are sticking to it. Section 2. The lifelong learner. Continuing your education. Your financial education should be an ongoing pursuit. The world of finance is always evolving, and the more you learn, the more confident you will become. Here are some reputable, non-speculative places to continue your education. The learning centers of major brokerages. Firms like Fidelity, Schwab, and Vanguard have vast, free libraries of high-quality, unbiased articles, webinars, and courses on every financial topic imaginable. These are fantastic and safe resources. Reputable financial news sources. Reading established sources like the Wall Street Journal, Bloomberg, and Reuters can help you understand broad economic trends. The key is to read for context, not for short-term trading ideas. Classic investing books. Reading foundational books on personal finance and investing is invaluable. Titles like The Simple Path to Wealth by J.L. Collins, The Little Book of Common Sense Investing by John Bogle, and I Will Teach You to Be Rich by Ramit Sethi have helped millions build a solid financial mindset. Government and regulatory websites. Websites like investor.gov, run by the U.S. Securities and Exchange Commission, offer excellent, unbiased tools and information to protect and educate investors. Be wary of financial influencers on social media who promise guaranteed high returns or promote speculative assets. True financial education is usually calm, consistent, and frankly a little bit boring. Section 3. The next level, looking ahead. As you progress in your career and your life, new financial opportunities and challenges will arise. Here are a few things to keep on your radar for the future. Maximizing retirement accounts. As your income grows, look into fully funding your IRA each year, and make sure you are contributing enough to your employer's 401k to get the full company match. It's free money. Understanding tax efficiency. You'll begin to learn about concepts like placing certain investments in specific account types to minimize taxes, a practice known as asset location. Avoiding lifestyle creep. As you earn more money, there is a natural tendency to increase your spending. This is known as lifestyle creep. It's crucial to make a conscious plan to dedicate a significant portion of any raise or bonus towards your investments, ensuring your future self benefits as much as your present self. Defining your why. Revisit your financial goals. Make them more specific. Instead of just saving for retirement, start to envision what that retirement looks like. Having a clear emotional connection to your why is the most powerful motivation to stay disciplined on your journey. Conclusion. Your journey, your future. Our series ends here, but your journey is just beginning. We have given you the map, the compass, and the essential supplies. We've shown you the tools, explained the terrain, and warned you of the pitfalls. The path ahead is now yours to walk. Remember the foundational principles. Start early. Be consistent. Keep costs low. Diversify broadly. And most importantly, stay patient. Do not let the short-term noise of the market distract you from the long-term, life-changing power of compounding. You have the knowledge and the tools to take control of your financial destiny. You can build a future of security, freedom, and choice, one disciplined investment at a time. The power is in your hands. Thank you for joining us on this journey. We wish you a lifetime of successful investing.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.